Hi guys, just a quick intro to GST here. Now you should already know, hopefully, that GST stands for Goods and Services Tax. Now the Goods and Services Tax wasn't introduced until the 1st of July 2000. And on that day, pretty much every accountant in Australia jumped for joy. Because the GST keeps a lot of accountants in work. Now, why do I say that? Because pretty much every business in Australia now acts kind of, so this is our business, but they also have a secondary role now. Every business is also a tax collector. So the ATO, that is the Australian Tax Office, uses every single business in Australia, well, not every single, but uses the businesses of Australia to collect tax from consumers. Okay, so let's think about how this happens. Business sells something. Let's say they sell it for, I don't know, $100. Now that's a pre-GST price. So if a consumer wants to buy that, they don't pay $100. They pay $100 plus the GST, which hopefully you guys already know. GST equals 10%. Nice round number here. Maybe that'll change in the future. That means that the consumer pays $110. Now, the issue here is that the business itself does not get to keep $110. The $100 goes to the business, and the other $10 goes here to the ATO. Now, this means that the business has to keep meticulous records because they're collecting tax, that $10 or however much it is, 10% of all of those purchases. They keep it in a big pile. And every 3 months, the business has to submit something called a Business Activity Statement, or a BAS. Now, it submits the BAS to the ATO, and then it gives the ATO however much money it's been collecting for them over the last 3 months. Now, that by itself would be fairly straightforward. Unfortunately, it's even more complicated again, because not only is the business collecting tax from consumers, but it is also purchasing things itself. So let's say the business goes to a furniture store. Now, if the business goes to a furniture store and buys, say, $1,000 worth of furniture, the business isn't just paying $1,000 worth of furniture. It's also paying $100 worth of GST. Now, the issue is this. The business isn't liable for this GST. So this GST becomes what's called a tax credit. So if you can see, what's going to start happening now is we're going to have incomings of GST from consumers and outgoings of GST whenever the business buys something. So the way that it works, I'm not going to do like the full accounting procedure here, but the way that it really works in actuality is that the business adds up all of the GST collected equals, I hate to use some maths here, equals X amount of dollars. All of the GST paid out equals Y amount of dollars. Now, the amount of money that they're going to give to the ATO at the end of the 3 months is going to be equal to GST paid to ATO is going to be equal to the GST collected minus the GST paid out. So you can see if it was just these two transactions, they wouldn't have to pay anything to the ATO. The ATO would kind of owe them money because they paid $100 GST, but they only collect 10. Okay, it's more complicated than what I've given you here. But what I'm hoping is you'll look at this and you have a general understanding of what's happening. The business becomes, every business in Australia, I keep using this caveat, you only have to collect GST if your business turns over $75,000 a year. If you want to talk to me about what turning over $75,000 a year, talk to me about that in class. But here is our basic idea. The business is a tax collector now. It collects tax, it holds on to it for 3 months, and puts it into here. Why are accountants excited about this? Because there is a lot of accounting that goes into this. Because the money that's coming into your account needs to get held aside so that the ATO can collect it every 3 months. All right, that's a quick intro to the GST. We're going to start looking at how this affects every transaction that we make next up.